Welcome back. We are on segment 7.2, and in this segment we'll be discussing what a term loan is and what are the various stages of a term loan proposal. So a term loan, as we discussed earlier in chapter 6, when we were discussing about balance sheet, there we have seen that the balance sheet, balance sheet we have the liabilities and assets. Under liabilities where there is an item called a term loans from banks, right? We see in this item. This we have discussed under term liabilities. So there are some term liabilities, there are some current liabilities, there are some owners funds. So under term liabilities, we have discussed an item called term loans from banks, and we also split this term loan outstanding into two portions, right? One is that portion which is falling due within the next 1 year. This we classified as a current liability, and the balance portion which is falling due beyond 1 year. This we classified as a term liability. So these are the basics which we discussed. So a term loan basically is nothing but a loan that is the repayment of which is predetermined. The repayment terms are very clearly spelled out. So when the borrower does the documentation, right? So it's very clearly mentioned what is the repayment. Say for example, the borrower has taken a housing loan of 10 lakhs. So the repayment is very clearly stipulated. This is 120 monthly installments, EMI of 15,000 each. Very clearly it is spelled out. This is a term loan. Term loan is the repayment period is specified, right? So the standard terms and conditions, of course, will include a condition called a bank may recall this advance at any point of time, right? Irrespective of this repayment schedule, even though, say for example, this is a repayment of 10 years. So at the discretion of the bank might after 5 years say repay the whole outstanding, whatever it is. Outstanding could be 6 lakhs. Then it might say pay it now. That is still option. See, that is still open. That option is always available to a bank. That is a safety clause to the banker, but it is not usually enforced. So we are not. Let us not worry about this clause. So when we speak about term loan, it is a credit facility where the repayment term is clearly spelled out, and the repayment is not something that's going to happen. Repayment is usually spread out. Is usually spread out, but it can also include a bullet payment. So what we mean is, for example, if I've taken a loan of 10 lakhs, so there could be various repayment terms that could be stipulated. One, it could be saying some spread in the sense that repay in some 20 quarterly installments, or 10 half yearly installments. So some 72 monthly. So it will be spread out over a period of time, or it could be a bullet repayment in the sense that repay this 10 lakhs after 2 years, starting 2 years from now, repay in one go 10 lakhs. So it could be, right? So whatever it is, the repayment is something which is available to the borrower at the time of availing the loan, right? So the purpose for which term loans are sanctioned, it is usually to purchase an asset, a physical asset, usually, right? For example, a machinery, a vehicle, right? A house. These are physical assets, right? So term loans are usually sanctioned for buying a physical asset. But sometimes they're also sanctioned for, say for example, an item like interest during construction. This is not a physical item, but then banks sometimes sanction loans. I mean, if we are going to discuss what is a project cost, right? So one of the items in a project cost, apart from the regular items which are aware, land, building, machinery, can be an item called interest during construction, and bank might decide to. Usually, it's not finance, but some banks might decide to finance 50% of their interest during construction. I mean, they can do that. So what we are doing is it's don't always be under the assumption that it's always a physical object that term loans are a sanction. There could be some not non-physical objects also, right? But they are costs associated with the project, right? So we are going to see them also. Similar example could be preliminary and pre-operative expenses. All this we are going to discuss shortly. So regarding the classification, we already discussed this. This is a long-term liability. It's a long-term liability, right? Banks sometimes classify these loans as short-term loans and long-term loans, and banks have their own criteria for following. Usually, it is a 3-year cutoff. So some banks may have a different cutoff, but usually loans whose repayment is less than 3 months, it is a short-term loan, and then loans with repayment period of greater than 3 years is a long-term loan. Usually, this distinction is made to impose what is known as banks usually impose what is known as a term premium, right? As a banker, you must be aware of this term. So what is a term premium? Say for example, a term premium. Let us say it is 0.25%. So what bank is saying is, if you borrow a loan of borrow a loan whose repayment is say only 2 years, so we'll stipulate 10%. But if you borrow a loan whose repayment is 4 years, that is more than 3 years, right? We'll charge not only 10% but a term premium that is yet 0.25. In this case, 0.25. So we'll charge 10.25. So they're imposing a sort of penalty for It's not a penalty, but longer duration loans carry a higher amount of risk because we are uncertain about what's going to happen so much into the future. So banks usually impose what is known as a term premium, a premium for the extended repayment period. So this is a one classification which you will usually come across in banks, right? Short-term loans and long-term loans. The exact cutoff could be varying from bank to bank, but usually 3 years is what is followed in the industry. So please understand that when you speak of term loan appraisal, don't just think that is just a financial part, right? So understand that financial the analysis which you're going to do to most extent. This book is all about the financial part, but yes, it's a very important aspect. But this is just one stage of the term loan appraisal. If you are a banker and if you have worked in credit, you have your internal bank process note, your internal appraisal memorandum. Yet there you could see that term loan appraisal is broken down into various subsegments. Like we have something called managerial appraisal. Then there is a technical appraisal, industry appraisal, financial appraisal. So you can see that financial appraisal is just one part of a series of appraisals. So when banks appraise term loans, they appraise this project from a variety of angles. So one, they see the quality of management, the managerial appraisal. Then we have a technical appraisal. So this is recalling the technology, right? This company is using and various other parameters related to the technology. Then there is the industry appraisal, how this industry is doing actually. This product is whether it's going to have a market and various other aspects about the competitors and stuff like that, right? Then there is a financial appraisal. So usually we are tempted to focus so much on the financial appraisal that we tend to give little attention to the other three. But then term loan appraisal is a holistic approach. You have to take a holistic view whenever you do a term loan appraisal. So all are equally important. In fact, there are people who just sanction loans based on manager appraisal. You will come across sanctioning authorities who believe so much in persons, individuals, that even if the financials part is a bit weak, they'll go ahead and sanction. If the people running this company are of high integrity, people who had past dealings with the bank and the dealings were very satisfactory. Sometimes the comfort level between bank and some customers is so high that everything else is relegated. I mean, you don't bother about the financials part. You will be coming across such situations. But then that is a exception. I understand that there are people who give varying amounts of importance. So out of this, for what is important is usually the best answer is you should take a holistic view. There is nothing like one is important. Some people may say this is important. Some may say the financial is important. Some may say the industry itself is important. If the industry is doing well, irrespective of whether your product is irrespective of whether the company is doing great or not, the industry will carry forward the wave of the industry. Say for example, a software boom in the early 2000, right? In the early 2000, a software boom was such that even small companies would just flourished. People with very weak fundamental just sort of flourished. So sometimes people give very high importance to the industry appraisal. This you will find especially in the case of real estate concept, especially in real estate. Yeah. Sometimes there will be a period where there will be a very high boom in the real estate, so there will be a bulk of sanctions. Then there will be a period where there is a very dull period. So banks won't go into sanctioning proposals to real estate, even though the promoters could be very sound, financially sound. They could be very of high credibility. The integrity is unquestionable. They have the financials are sound, but even then bankers will be hesitant to sanction to particular industry. So at various points of time you'll be coming across sanctioning authorities who place some will say this is important, the quality of management. Some will say the industry is important. Some will say the financials, the balance sheet is important. So some will say the technical part is important. So what I'm saying is financial appraisal is just one part of the credit appraisal. What you should be taking is that what you should be doing as a credit officer, you should be taking a holistic. You should be doing all appraisals and coming at a balanced judgment, right? Of course, we'll be in this chapter we'll be discussing this very briefly. Of course, the major focus of the book is financial appraisal. This will go in depth. The other points we'll be touching upon briefly in this chapter, and then later when we take a case, then we will go into depth. Then we'll go into depth into each of those other appraisals. So let us discuss the appraisals briefly on this segment, right? So first of all is the managerial appraisal. So you will come across many bankers. In fact, most of the bankers believe this is the key appraisal. So of all the four appraisals, they believe this is the key appraisal. Whether your promoters, whether the people who are running the company, whether they are of whether they have the credibility and the capacity to run the business. If they are of high integrity and when they have the and they have the business acumen to run the business, bankers go ahead and sanction the loans. This you'll find in a number of situations. There'll be some field inquiries conducted. So what you sometimes call it by the name of due diligence, right? Sometimes you call it by the name of credit investigation. So whatever it is about to inquiries all about getting an idea about the credibility of the borrower. So if a new borrower comes to the bank and you want to and applying for a credit facility, so you don't know anything about the borrower, you don't have any past history of this borrower. So what you do, you make some discrete inquiries. You make some discrete inquiries in the market, right? You, as a branch manager or your field level staff, so your staff working in the bank, you'll be going into the market inquiring with the competitors, because bankers will be dealing with a lot of companies. So since a bank is basically into the business of lending, they will be having contacts with a lot of business personnel, right? So, a lot of business people. So this is quite easy. It's not that difficult as you think of. So say for example, a new company has come in, right? Say for example, a fertilizer a company has come for sanction of limits. The bank is already so the bank might already have sanction credit facilities to other fertilizer companies in the area, in the same area. So easily they can approach the particular competitors and just inquire about this person, right? Or if there are no fertilizer unit sanctioned in this zone, definitely, say for example, they know other businessmen, and since businessmen in this particular field, they know each other, or they usually usually know each other. So it's not difficult to get this knowledge of this borrower. This field level inquiries are not that difficult as you think of. So you'll be getting a fair idea of what sort of a person this promoter is. Now, whether his integrity is good, whether he has any outside borrowings. Now, what is the net worth of this customer? How financially sound he is? What are the relations he has with the labor? All these stuffs you can get from this field level inquiry. So managerial appraisal is first, in fact, the first and foremost appraisal you should be doing whenever we are going to discuss a checklist, right? Checklist in chapter 17. So there will see what are the things that you should be doing in a interview. So interview is the first stage when the borrower comes to the bank. See, when the borrower comes to the bank, you actually want to have an informal chat with the borrower. You just sit with him and discuss some issues across the table very informally. So in that interview, you'll get to know a lot about this particular promoter. So that is the first stage where you get to know the person. Then you will be doing some field level inquiries, right? To get a better idea of the promoter. So managerial appraisal is the number one and the most important appraisal you need to be conducting, because business at the end of the day is run by promoters, right? A business does not run by itself, right? You might have encountered a term called willful defaulter, right? Willful defaulter means this person has funds to repay, but he's not repaying. So he has borrowed funds from the bank, but he doesn't want to repay. So these are people who have very low credibility. These are people whose integrity is low. You don't want to be dealing with that sort of a person. If you can identify such borrowers, if you know that a particular promoter has this sort of a mindset, his integrity is not good, even before sanctioning, that will be great. As a banker, that would be fantastic, because then there is no risk of the account turning bad. So what you are basically looking at the managerial appraisal is the credibility, right? Right, and the capacity to run the business. What is the business acumen? Right, this is what we mean by capacity. What is the business acumen? Whether the promoters can run the unit successfully, and then there's the other part, that is the integrity. Whether these people are of good integrity, right? Because you don't want to be dealing with dishonest people, right? So having done the managerial appraisal, the next appraisal is the technical appraisal. So what we do in this aspect of appraisal is we look at the technical feasibility of the project. See, please remember that the financial or what we call the economic viability. The economic viability is something a different part, and technical feasibility is a separate part. A project can be financially, right? It could be financially, economically viable, but technically it might not be feasible, or vice versa. It could be technically feasible, but it's not financially viable. You want a project that is both technically feasible and economically viable. So what usually banks for large projects, what is usually conducted is a TEV study. TEV study is a techno-economic viability study. So what this study ultimately aims to determine is whether this project is both technically feasible and economically viable. So in technical appraisal, we'll be dealing with items such as related to the location, for example. location of the plant, whether the decision to locate this plant in this particular area is a correct decision or not, the capacity of the plant, raw materials, the source from where it is going to be, where this unit is going to get the raw materials, the labor, and various other aspects. We are going to see the various items that come here. But from the TV study point of view, you have to understand that the company will usually engage a independent outside agency that does this study. So if a company prepares, usually I'm speaking of very large projects. So if a company does a TV study on its own, there's no point in the bankers believing it, right? So because if a company bites on its own, prepares a TV study and says that our project is technically feasible and economically viable, I mean, you should not be surprised. No, that's what the company will be saying. So banks usually depend on some independent outside agency that does this job. There are companies who do this, right? So those TV reports are usually submitted to banks in case of large projects. Maybe in case of small projects, maybe banks will accept the TV study prepared by the companies themselves. Okay. Since you'll be coming across a lot of TV studies, right? There are some points that you should keep in mind as a banker. As a banker, whenever you're dealing with TV studies, there are a few points that you should be keeping in mind. The first point is the report is not sacrosanct. Please remember that TV report is just a report prepared by an agency. Please remember the report, the findings may not always be correct, right? So they are also in the business. They're not in a business to actually say whether the project is truly viable or not. Maybe the project is not viable and they have given a report it is viable. This project is not viable. They have given a report it is viable. It is entirely possible because they are in some business. See, their business is to do a TV study and obtain a fee from the company. So which company will so if they keep doing appraisal upon appraisal, say 10 or 100 appraisals, and say every appraisal is not viable, so nobody will be going to them. In future they won't have any business. So you should understand the business interest of the TV agency, the agency that is conducting the TV study. That agency has a business angle to it. So this report, you should question it. You should critically examine this question. So just as you question the company and its balance sheet, you should also question the TV report findings. Just don't take anything, whatever is mentioned in the TV as sacrosanct. Don't take it like that. You should question critically, analyze the report findings. And if you're not comfortable with any finding, you should definitely call for further details, right? That is the first point you should keep in mind regarding TV study. The other point is always ask for credentials of the agency. What are the projects they have done in the past, right? Please inquire with the customer. This agency should have done some projects in the past. So once you, so that will throw light on the capability of this agency. So what is the size of the projects they have appraised? So say for example, you are right now considering a power project. This is a big power project, 1000 megawatts power project. A company has approached your bank for loan, and this TV study is prepared by some agency. Then if you ask for the credential, they said in the past we have done some 4 or 5 projects, 100 megawatts or 50 megawatts, 200. You're not very convinced about this. I mean, because this is a huge project. Whether they have the expertise to really determine this project is technically feasible. So please always ask for the credentials of the agency you have done this study. And also, it is very very important. It's not just preferable. In fact, it is crucial that this agency is not related in any way to the company. This is obvious. You don't want the agency to be having a vested interest, right? If this company, this TV agency is in some way related to the company, you should definitely avoid, right? You should always insist on a different agency, because they'll be having a vested, because this company will be having a vested, because this agency will be having a vested interest in submitting a proposal that is this project is financially viable. Okay. So one more point you have to be careful is the consultant. Usually, in some cases, you'll see that this consultant, that the agency which has prepared this TV report. So this agency that has done this TV study, maybe TV reports is just one aspect of the business. Maybe this agency was formed by some group of engineers. So these engineers, their business is one report. One business is the TV reports. Maybe they are into other business, like they are into some consultancy, right? They might be into some fabrication, right? They are into various aspects. So a company who is starting a project may hire this particular agency as a technical consultant. They might be seeking expert advice on say for example the sort of machinery they have to purchase, who are the suppliers from whom they have to purchase the machine, the various consultancy services. So in this sort of situation, you have to be very careful. You see, this agency, when this agency is doing the TV study, it has to comment on the technical feasibility. It has to comment whether this particular technology this company has adopted is correct or wrong. It has to say whether this particular supplier from which this machinery sourcing is standard or not. They have to comment on various aspects. But if this agency is also the consultant, if this agency also is into fabrication, also is a machinery supplier, I mean, there'll be a lot of conflicting interest here. You should not be getting into this sort of situation where this agency is into various businesses and this company is availing the services. On one hand, it is doing the TV report. On one hand, it is obtaining availing the consultancy services. On one hand, it is purchasing machinery from this supplier. You should not be encouraging these sort of agencies, because what's going to happen? Ultimately, a vested interest is going to creep in, right? Suppose there's a choice between two machines, right? The two competing technology process. So the consultancy may suggest that so this particular machine will bring in more income for you. They might suggest to the buyer, right? Which actually they might be producing. Okay, there is a choice between machinery 1 and machinery 2. This machinery they're actually fabricating. This agency is also into the business of manufacturing this machine. So they might suggest this is the better machine when actually machine 2 is the better machine. So you have to be careful in such sort of a situation. So always ask for the credentials. The credentials of the agency, right? Credentials in the sense that what are the past projects they have done. That is one part. The second part is inquire about their entire business. Inquire about the entire business. Are they just into preparing TV reports, or do they have other reports? What is this company into? Is it into other activities like consultancy, right? Fabrication, right? Engineering services, and has the applicant borrower company is availing any of these services also? You have to inquire, right? One more point you have to be careful in TV studies is there is a fees associated with this TV studies. TV studies are very expensive. Maybe small reports are done for 1 or 2 lakhs, but big proposals, say 10 lakhs, even crores. I mean, it can run into crores. Very large projects. So there is a fees associated with TV reports. So when a company pays lakhs or even crores for an agency, it is natural to expect that the report will be favorable. You should not be surprised that the report is favorable. See, why would a company pay lakhs to someone just to tell that the project is not viable? I mean, here we have a company and here we have a agency. This company, why would it pay some 10 lakhs or 20 lakhs to this agency just to get back a report that says this project is not feasible? There is no sense in it. And even if it gets the report, the company will not be submitting this report to the bankers. But what it will do, it will go to another agency, get a fresh report done, and maybe this agency will give it is a favorable project. This they will submit to the bankers. So please understand that. Expect the report to conclude. You always expect the report to conclude the project is technically feasible and financially viable. The first thing the many times that I see credit officers, when they get a TV report, they go to the last page, because last page there is something called conclusion. In the conclusion, they will see whether there is a statement that says this project is technically feasible and economically viable. Once they see this, okay, they'll close the report. Nothing else. This 100 pages or 200 pages report, they don't go through. Simply they see the statement. So this TV study has concluded this project is technically feasible and economically viable. There's nothing great about it, right? You should expect this statement. There's nothing great about it. A agency which is in the business of furnishing TV reports will ultimately, in most cases, present a favorable case to the party. It will say this project is technically feasible and financially viable. So keep this in mind when you scrutinize the reports, right? You should always critically scrutinize the TV report and see whether the agency itself has done a good job or not, right? Then one more point is some banks have their own technical appraisal cells. Maybe in your bank you have this technical appraisal cells. So what they do, they themselves conduct the TV study. This is actually done as a fee-based income for banks, right? This is a consultancy services. So this again should not be encouraged, but then this is a one business avenue for the banks. They are getting into this. It's not good because you are in the credit department, right? You are into processing proposals. You are a processing officer, right? And then there is this technical appraisal cell which takes up the case of a particular project, and concludes that this is technically feasible and economically viable. So this borrower comes to you happily and says your bank itself has done this, appraised this project and said this is technically feasible and financially viable. So as a processing officer, definitely there's very little you can do. You cannot decline it. I mean, you can still question it, question some. You can still say that this point is not correct, and I mean you can say that sort of stuff. But ultimately, when your bank, when a department of your bank has certified that this is a feasible proposal, you cannot decline it in a true sense, right? You not be having that much flexibility as if this proposal has come from an outside agency. Had this proposal come from an outside agency, that is different. Then you can critically comment on the various points. But if it comes from your bank, from the technical appraisal cell of a bank, you'll be having some limitations, obviously, right? They can't be competing views from same bank. Two departments of the same bank cannot be presenting a different picture. So this is precisely the reason why banks should not get into this business, right? Because there will be a conflict of interest at some stage. At some stage there will be a conflict of interest. But in any case, if you are a credit officer and you come across the scenario, please always scrutinize the report with the same rigor as you would do for other outside reports. That's the first thing you have to do, right? Even if it is coming from your own bank technical cell, you should scrutinize the report as if it has come from an outside agency with the same critical rigor, right? You should be appraising it. The last point regarding TV reports, banks have their own guidelines regarding TV reports. Say, for example, your bank has said all projects with project cost above 20 lakhs TV is a mandatory document, right? So now a project of 10 crores has come to you. So as per your bank policy, this is not mandatory. A TV study is not required. But then as a banker, you are entitled to call for a TV report. See, you as a processing officer, you maybe your senior manager grade, maybe your chief manager grade, and some of the higher ups, AGM, DGM, have come to a conclusion after discussing that we need an independent outside certification from an outside agency certifying the technical feasibility of the project. This they can do. This is entitled to do. Even though the bank overall policy is only projects above 20 crores need a TV study. If the bankers in the combined opinion feel that we need a independent certification, they can do that. So there are cases where even though the ceiling is not breached, even for the lower limits, banks sometimes get the TV reports done. So you have to understand there, right? The point you have to understand here is, so you call for that TV report. So the borrower spends some 5 lakhs or 10 lakhs and gets this report. It is a favorable report. The report has said it is the project is technically feasible and economically viable, and then he submits to you, and then as the bank you decline the proposal. Now, this is a very embarrassing. It's a very embarrassing situation, right? See, you can decline the proposal if this report is not favorable. But once the report is favorable, right, you cannot cite other reasons like we are not happy with the collateral. No, the collateral is not good. Please give us some of the collateral. Now you cannot say those sort of points. Because it will be very embarrassing. The borrower will be asking, why did you make me spend some 5 lakhs on this proposal, on this TV report, when you had this issue which has got nothing to do with the technical viability. Now, if you told me you're not happy with the collateral, I would have gone to some other bank. Why would I have wasted 5 lakhs? So please understand that when your bank doesn't stipulate for a TV report, but you call for the report, make sure that you're entirely satisfied with all aspects of the proposal except the TV part. So you are convinced about the proposal, and once the TV report comes favorably, you should sanction. So you have addressed all possible gaps in the proposal, and you are ready to take up this proposal, ready to sanction this proposal once the TV is favorable. Don't decline a proposal. Once you call for the TV proposal, once it comes favorably, then you say then you find a new gap, not related to TV, some collateral, or maybe your order book position is not strong. You have very low orders. Don't cite those sort of reasons, because it is very embarrassing. You should be clarifying all issues even before the TV report is called for, right? So you should remember that don't specifically tell a company to get a TV report unless you are satisfied with all the other aspects. Once you are satisfied with all the other aspects, you should be sanctioning the proposal once you get a favorable TV report, right? So the other appraisal, the third appraisal, is the industry appraisal. So you should understand that companies don't operate in isolation. Companies are operating in an environment, right? There will be other companies who are engaged in the same line of activity. Say, for example, you are a rice mill. You are not the only rice mill in the country or in the region which you are operating. There are many other rice mills in the same business. So you are operating in an environment called the rice mill industry. Similarly, you could be a cement manufacturer. You are operating in cement industry. You are a steel trader, operating in a iron and steel, broad category of iron and steel industry. So you are operating in an environment, right? So when appraising a company, you should always pay attention to the intercompany comparisons and the industry analysis. So these intercompany comparisons, you can get it from your own bank's data. If your bank has sanctioned similar units engaged in the same line of activity, you can compare this company with the other companies. But if you're not done that, you can get this information from your neighboring zones who have done this sanction. Maybe you're in, say, in Bombay zone, right? Maybe you're in Bombay zone. Then if you are not sanctioned this particular activity, maybe you can call up your neighboring zone, say from Gujarat. Or you'll be always having access to your colleagues in other zones. So you can always get this information. You can also get this information from other sources like Provis. This is a product from CMI. And industry analysis you can actually get from CRISIL Research, who publishes very good industry information reports, industry analysis reports. And most banks will be subscribing to these services, right? And it will be available to you through the intranet, right? You should be available. You should be getting access to all these services. So make the best use of those services. So only when you judge a company against its peers, unless you do that, what we discussed as a peer group comparison, right? Unless you do that, you will not be getting a correct appraisal. Because see, a profit margin 25% is excellent, really excellent. Usually you will see profit margin of 5% or 10% at the max. A 25% profit margin is excellent. So when you see a P&L account of a company, you see a financials of a company and see this profit margin 25%, you might say, oh, it is the best company. But then if you dig deep and you see that every other company in the industry is actually generating a profit of 40%, then there's something wrong with this company. All right. So here lies the intercompany comparison. So in isolation, this might be a great figure, but in comparison, this is a very poor figure, right? So always make it a habit to do what is known as the cross firm comparison, and also the industry analysis, right? Industry as a whole, how it is doing, right? And within the industry, how the applicant company compares with the other firms, right? This is especially relevant in certain sensitive sectors. Say for example, real estate, right? So bankers will usually be going by real estate, uh, right? So this particular period, real estate is bid down in this city, so they'll go so on sanctions, right? Because this is a sensitive sector. As a whole, how it is doing, they'll be seeing. Or take for example power. If you remember in 2012 and 2013, right, banks were actually going very slow on sanction to power projects because the exposure was because already they have lent a lot of because especially the public sector banks already they have lent a lot of funds to power companies, and actually they were taking a bit of low exposure to power companies during this period, right? So industry analysis is important, right? So how the industry as a whole is doing, what is the exposure you have to this, your bank has to this industry as a whole. So there will be critical factors in doing this industry appraisal. And then of course the last one is the financial appraisal, which will be anyway, that is the focus of this book. So we're not going to delve into this separately anyway. So in this chapter we are going to discuss all the financial aspects of the terminal process, right? All the ratios and the various components of terminal appraisal we'll be discussing in detail. Okay, so we'll end the segment. We'll end the segment here. So in the next segment, that is 7.3, we'll be discussing about these four appraisals. We'll be discussing that these four appraisals are really not as difficult as you might imagine. These four appraisals which we discuss here, that is the managerial appraisal, technical appraisal, financial industrial appraisal, and financial appraisal. They might be intimidating. The terms might be intimidating, but actually it is plain common sense. Why it is so, we are going to discuss in the next segment 7.3, right?